Awesome. We will start pretty soon. I'll just wait for everyone to come in. But good to see Annie. How are you? Chess. Few names that I'm very familiar with. Few new names. I'll give a proper introduction in a moment. But I'm Alex, head of customer success at NetNada. So responsible for guiding all of our customers through our platform, through carbon accounting, achieving a range of different sustainability goals. I've been working in the carbon accounting space myself for nearly 3 years now. Previously in the sustainability space, but primarily now working in carbon accounts. So very excited to take you through the basics of it all with a bit of a lens today on events. So we're going to look at carbon accounting, but we are primarily going to look at it from the perspective of calculating carbon emissions for events. Any questions? Shoot them over. Don't worry about taking too many notes. We will get in touch within the next few days and send you a recording. We'll also send you any other details that might come through. So please, any questions you might have, send them over. Otherwise, we'll be able to cover everything off pretty quickly today. Take about 30 minutes, and then we'll have time for some questions at the end. So I think that will do for waiting for everyone. If you missed before, my name is Alex. I am just trying to get in the view at the moment. I'm head of customer success here at NetNada. My role at NetNada is very much preparing, creating, and then leveraging the carbon accounts for all of our clients. What NetNada does at its core is a carbon accounting platform, but then layered on top is the access to a range of our different consultants, such as myself. But today, we want to take the term carbon accounting and really break it down into its most basic elements, and then also apply those elements to events. I'm a big believer of just taking a bit more of a basic approach to all of these terms that are just so present in our everyday vernacular and the sustainability space so that you can build a better foundation of understanding what's going on, what needs to be done from your company's perspective, and also create a safe space for everyone to ask stupid questions. There are no stupid questions today. There are no basic questions. So please shoot them in the chat and we'll get to them at the end, or just jump in as needed. So a little bit about NetNada. Why are we hosting a Carbon Accounting 101? Why are we in a good spot to be hosting a Carbon Accounting 101 webinar? We have been calculating the carbon emissions of not only Australian businesses, but businesses across the world now for just over 4 years. Now, I myself have been doing it for just over 3 years and worked with every type of industry, big focus and a lot of experience in the events industry, property, GPT, Colliers, CBRE, done a lot in the event space. Half the team is actually down at the Australian Business Events Association conference right now, down at the ICC, with which we are the sustainability partner. So I've actually just jumped from working on their report and looking at how we're doing their analysis onto this webinar. So we'll touch on some of that today. But again, at our core of what we do is around carbon accounting 101. And I have worked with people with no experience to very, very detailed experience. So again, we really want to demystify the whole concept. And that's why today we're going to take it down to its most basic of parts. When we first started selling NetNada and trying to pitch it to businesses 3 years ago when I came in, the pitch was very, very different. And this is the same as well. A lot of the people I can see on this call of who I know and some of you who I'm sure are in this kind of position. It's like, how are we going to take, carbon accounting or sustainability and turn it into a competitive advantage or a way for us to, improve our customer relationships or win more business? Because at the end of the day, this is a business decision that we're making to calculate our carbon emissions. The drivers for that have become so much stronger in the last few years. And that's because we're seeing a lot of heightened regulatory pressure. Mandatory reporting requirements is the big one at the top end of town, but then that's having a ripple effect. And there's other things like the Australian government procurement policies coming out, putting pressure on, starting off with the construction services industry. All of these sticks incentive, you get smacked if you don't abide by them, are also now coming into, carrot incentives. And this is leading to just increased stakeholder expectations. What used to be, oh, you want to, strengthen your commitment to sustainability by calculating carbon emissions. Now it's carbon is the data point that is driving any commitment to sustainability from a legitimate perspective. So we can talk about the Paris-based targets in a moment, but this is the big picture. That's what we're going to do first, zoom out a little bit. And I really think it's helpful to contextualize how we got to this point that we're all sitting here, talking about what is carbon accounting. And back in the mid to late 90s, there was the Kyoto Protocol that came out of the first kind of major UN convention on climate change. So in the late 90s, it was decided, or we're well aware, that greenhouse gas emissions were having a negative impact on our environment. They were potentially leading to, back then, the thought potentially leading to climate change. So there was a commitment that we need to calculate them, we need to reduce them, but we don't even know, back then they didn't even know how to calculate it. And so this is when the creation of the GHG protocol was created. GHG stands for greenhouse gases. All the time you'll hear any carbon accounting tool or someone doing carbon accounts is worth their salt or is trying to, show their legitimacy or authenticity, we'll mention, and we say it all the time because it's very important, we align with the GHG protocols. And the alignment with the GHG protocols is because the GHG protocols is what governments, what countries, what major corporations are using to calculate their carbon emissions, because we need to be using the same methodology if we want to be able to compare, contrast, and reduce. Now, it took quite a while from the late 90s to 2015. 2015 is when the Paris Accords, the Paris targets, came out of the 2015 UN meeting, with which all of the major developed countries of the UN said we need to band together to reduce global warming by 1.5. So we need to keep it under 2 degrees to 1.5 degrees of heat additional from the pre-industrial levels. So that was at the first time the targets were put in. You may hear people being aligned, not aligned, pulling out, so on and so forth. Now in the 2023, 2024 is when we started to see this mandated into the private sector, not just governments, and governments trying to keep in with their Paris targets, of where they've set these net zero targets for 2030, 2040, 2050, whatever they may be. But now we're starting to see this actually become law within the private sector. Greater sustainability landscape. Again, we touched on that mandatory reporting requirements. There's blueprints all over the developed world. When we first put together similar sort of presentations such as this, the Australian government procurement strategy hadn't been released. It has been released, very, very recently. But essentially, what governments will be doing is they won't be awarding government contracts to companies who are not demonstrating a commitment to sustainability, and that commitment to sustainability is always grounded in carbon. There's a lot of industry-specific legislation. Again, we want to take a bit of an event perspective to this all. There isn't so much in the explicit event space that's come out as like law or legislation. There's a lot of hints. What we're seeing from like major events across the world, they're not going to bring these major international events to locations that don't have, strong sustainability commitments. But the interesting thing about events, and the reason why we're very involved in events, is that it's such an interconnected industry. You may be an event for the construction industry, and they use the construction industry first because they're the first one to have that procurement legislation come out. So there's a lot of opportunity. Everyone here will be sending out communications, but we'll constantly update you as to any any opportunity from a legislative or legal perspective that's coming out. But at the moment, nothing really specific to the events industry. This is the big one. I'm not going to spend too much time on this, but it's essentially the mandatory reporting requirements criteria. So the group one from January 1st, 2025. So companies with 500 million or more gross revenue, billion or more consolidated assets, or over 500 employees, they're going to have to start reporting their scope 1 and 2 as of next year, so on, so forth with these smaller companies. And then that'll be scope 3 coming in. Haven't announced the exact dates, but what scope 1, scope 2, scope 3, I thought this was carbon accounting 101. We're gonna touch on in a second, but just to take it back to say, what is this big picture before we break it down even further, is that there is more legislation coming. It's coming from both a mandatory reporting requirement perspective at the top end of town, and there's also a lot of opportunity for anyone working in grants, tenders, or working with government to win more work because they're also using it within their procurement policies. There's more legislation, there's more expectation. Now more than ever, there has been more pressure to be playing in this space or to at least have some progress in this space. Now, transparency is the most important thing, as we'll touch on in a second. So don't be worried if you're behind, because you should only really be a little bit worried if you're behind if you're a company over 500 employees and you don't have any plans for how you're doing to do your mandatory reporting requirement as of next year. Everyone else, nothing to worry about too much at the moment. Key terms. So we have obviously carbon neutrality versus net zero. This is an easy win for people who are new to the space. These terms get used interchangeably all the time. Oh, we want to be net zero next year. Unfortunately, that is physically impossible at the moment to be net zero. Carbon neutral is, well, carbon neutrality is something that many companies embrace and look to at the moment. And carbon neutrality is the calculation of all your carbon emissions and then the offset of those carbon emissions. What's offsetting? We'll touch on that in a second. Net zero, though, is the reduction. You are emitting no greenhouse gases. Now, scope 3, scope 1 and 2, it's possible at the moment to be emitting no scope 1 and 2, but the ability to emit no scope 3 emissions across your supply chain is, pretty much impossible at the moment. So this is why net zero targets are so far in the future. They're like 2040 or 2050, or we make a 2030 commitment to be 50% towards our net zero target. And this is because the technology just doesn't really exist, or the adoption across society doesn't even really exist for companies to be net zero. Two other definitions you'll hear thrown around a lot: materiality assessment, which is essentially just evaluating which emissions risks or impacts are significant to influence stakeholders' decisions on the company's performance. AKA, what is important? There's so many areas of calculating emissions, there's so many areas of sustainability. What has the most material impact? Where should we focus? That can guide decisions, governance, all that sort of thing. Emissions boundaries can be quite similar from an emission. You can use materiality assessments to guide your emissions boundaries. Emissions boundaries is what are we including within our carbon account? What is included, excluded? And again, these scopes and limits, there are many rules. We're not going to get into that today as to how you do it, but it's just the understanding that when people talk about what are the boundaries here, it's like, have we calculated this one type, yes or no, of emission source? Now, the reason why we don't need to get too much into that is because there is a lot of opportunity for improvement with carbon accounting. And one thing I always say is that it's actually a little bit misleading, the term, I believe, carbon accounting, because accounting itself is so black and white. It's binary, it's wrong, it's correct, it's incorrect, it balances or it doesn't balance. Carbon accounting, there's an iterative process of getting more granular data, getting a more accurate analysis. CO2e, again, another easy kind of knowledge win is like, it's not just carbon dioxide that we're calculating, there's methane, nitrous oxide, water vapors, but it's all equated into carbon. So carbon dioxide equivalent CO2e is actually what is referred to when we're talking about essentially carbon emissions. And that's because methane is like 32 times as strong as as carbon from the perspective of damaging the ozone layer and so on. So emission scopes, these are the scope 1, 2, and 3 that were born out of the GHG protocol, the corporate standard, what we talked about coming out of the late 90s. I found this really confusing. The first few times I kind of learned about carbon accounting, carbon emissions, because it doesn't really make sense. And that's the division of all emissions into 3 categories: scope 1, scope 2, scope 3. This is not a NetNada definition. This is international, accepted across the world, how emissions are divided. Scope 1, these are your direct emissions from owned and controlled sources. That is the definition. You can see why it can be a little bit confusing. This is your gas, your fuel consumed on site, consumed in the general operations of the business. Scope, there are little bits of inclusions and exclusions, but just think about that as, mainly your fuel and gas. Scope 2 is your indirect emissions from your electricity, purchased energy, consumed away from the site of your office. But again, scope 1 and 2 for a long time was all that was calculated, because you can calculate these relatively easily. Scope 3 is your supply chain, your value chain, all indirect emissions coming from the company, but just think about it as everything else. Again, a little bit confusing, but if we kind of zoom in here, we got our company vehicles, we got our company facilities, the gas and coming from there. And then scope 2 is the purchased electricity and cooling, everything else. Again, like I said, it took me a few times to really kind of wrap my head around, what was included and not included in each of the scope. But it's important to understand that scope 1 and 2 is quite easy to calculate, and scope 3 is quite difficult. Now, scope 3 is usually depending on the nature and industry of the business. Sometimes if we're talking about an events company that works out of a co-working space and doesn't have a fleet of vehicles, you would have 0 scope 1 and 2 emissions. You'd have all scope 3 emissions. Most event companies we look at, they're 92 to 99% scope 3 emissions. It's a major part. It's the main part. And you'll know that through here, it's just scope 1 and 2 to start off with. They're not going to expect these massive companies to figure it out. We'll send this through as well. I kind of added this in more for the events as like something to have a bit of a thought about. There's so much to calculate. And the first time you do a calculation, the first time you do a carbon account, it's often best to just set your boundaries, decide what's material, and set your boundaries to just be focusing on what's material. So, but the key is to be transparent about what you include and what you haven't included. And now these are, a bit of a decision tree taken from a resource we really like. Is money being spent directly? Yes. If we're spending money directly on it, then we know we should be including it. No, but is money being spent directly on behalf? Yes, and then it's indirect spend. Would this activity occur if it weren't part of the event? No, then it's an attributable activity. This is just one way of figuring it out. But again, I guess what am I trying to show you here is that there is a process before even starting to pull all the data together and calculate it to figure out what is, important in terms of the carbon account. And when the carbon account is like, what are we measuring? What are we calculating? What needs to be included and excluded? Now, I was just speaking to the sustainability manager at the ICC before. She asked me, Alex, can you send over the data points that I need to include, or the data points that I need to extract for you to do the ABEA conference analysis? And I said, okay, well, it needs to be electricity, it needs to be the attendee travel, it needs to be all of the third-party services that were getting involved. And I kind of listed all the different things she needed so that she could wrap her head around what data points she had to pull through. If you're doing a carbon account, if you're working with someone who's helping you with your carbon accounting, this will be done for you. Setting your boundaries for sure. But it's just important to understand that this is a first step, figuring out what is within the influence. I think it's a difficult step to start off with, certainly. Emissions in your value chain, again, upstream, downstream. A lot of the time, mostly it's upstream activities that are calculated. I'm not going to go into it too much today. It's just a slide that we'll send across, but again, touching back to what's important to take away from here is that scope 3 is the major part. And because scope 3 is so detailed, it contains so many different other aspects of your business, it is something that is generally needs to be solved using technology. If you wanted someone to calculate your scope 3 emissions without technology like NetNada or one of the other services on the market, it is going to be so expensive and time consuming and difficult to do. And you'll see why in a second. And this is just a bit of a blown up. This is taken from the GHG protocol. This is how they break it down. So this is not the only, these are the categories that the GHG protocol does, but again, people like us, NetNada, Climate Active, other people who are calculating your carbon emissions will make these a little bit easier to understand rather than, trying to speak to someone about certain aspects such as like end of life treatment of sold products, which is difficult to calculate. This is probably sorry, questions. This is probably as complex as we're going to get today, but I think it's important to kind of understand how calculations are done. So with most carbon accounting methods, nearly all carbon accounting methods, the hybrid method is used. Now, the hybrid method is the use of the spend-based approach and the activity-based approach against an environmentally extended input-output method. And what does that mean? It means that either activity units or spend units are being applied against an EEIO model. Now, these are some of the definitions, but I always feel like it's easier to show you an example to better understand it. This is an example taken from the NetNada platform in the back end, and it shows how we have used the spend-based approach to calculate the carbon emissions of spend on a laptop. So what it's saying is that for the environmental extended input-output method, you need to take your input and you need to either choose if you're using spend-based or activity-based. In this case, we're using spend-based as we're using a dollar input. The input is $1,160, and then we're applying that against an emission factor. Now, an emission factor is the best way to understand an emission factor, because this is like essentially at the key of the IO, is that there are internationally accepted, and they are a data point that has been boiled down from a very, very, very complex, often hundreds of thousands of sets of data points to represent an average across either an industry or an activity as to the associated carbon emissions. Now, in this case, it's dollars spent on computer and technical services in Australia is on average equal to 0.14 kilograms of CO2e per dollar spent. So this $1,160 spent on this emission factor is 0.16 tons of CO2e. Now, just at this supplier, there's 28 transactions. On average, for a company around 20 employees, we'll usually see around 4,000 transactions, 4,000 data lines that we need to analyze. So if you were using previously before technology, all 4,000 of those data lines would have to be allocated into the correct emission factor, which is obviously very time consuming and difficult. Now, you may ask, well, that doesn't seem very accurate. Well, I certainly have thought this before, and there's plenty of cases. Like, we're just taking an average. Now, there are hundreds of emission factors, so you can kind of attribute what is the closest. But as I mentioned, this is an iterative process. Now, spend-based emission factors play a very, very important role in covering analysis when there isn't more accurate or granular data available. Another level using the hybrid model is the activity-based. So rather than just using dollars spent, we're using other units of measurement. All other units fall under activity-based. For electricity, we would use invoices that show us the kilowatts per hour consumed rather than the dollars spent. Because if company A is hosting an event at ICC, they may be spending more money on venue hire, but it's actually one of the most sustainable venues available in Sydney. So we need to move beyond just looking at the dollar spent on venue hire, for example, and look at what is the kilowatts per hour consumed for electricity, or what is the waste used associated emissions for that venue. Now, our system, NetNada system, is able to input. We scan your electricity bills. We pull out the kilowatt consumption hours. We replace the dollars spent with kilowatts per hour consumed. We do the same thing for waste and recycling. You look at kilograms or tons of waste processed rather than just money spent on your waste bill. Same as flights, rather than saying, we spent $1,000 on Qantas for this flight. It was actually 10 flights, which have a very different emissions associated. So you want to be using activity-based data where possible, but it's not always available. We don't have that granular data for everything, so we need to use spend-based where we can't. Now, this is a decision tree that I think really shows the importance of spend-based method, because an example I had recently was a client who they were a financial services client, and they came back to me, and their number one supplier in their Scope 3 emissions was Bloomberg, because they were paying a lot of money for these Bloomberg terminals. These little bits of technology hardware that sat in the office for their traders, but they were spending hundreds of thousands of dollars on them. And he's saying, well, I don't understand. It can't be that many emissions coming from these small terminals, but it's like our highest supplier. And I said, okay, well, we can't just try and he presented me, very smart guy, this like backwards model of like Bloomberg's total emissions based on their sustainability report was X. And then they have 10,000 terminals, and we've done this division, all this stuff. I go, yeah, that's really strong. But if we're trying to align with the GHG protocols, you need to be taking into consideration as to whether there is like actually granular data available on what you're analyzing. And a lot of the time there isn't that more granular data. So to start off with, you need to be using the spend-based method we looked at. Now, what we always want to do is graduate. I like to use the word graduate from the first analysis. So, we may have done an event where we looked at venue hire, and we just said we spent $10,000 on venue hire. But next year, instead of just looking at the $10,000 spent, we do a more granular analysis on the exact, how much space we took up at the venue, the kilowatts per hour consumed at the venue, and so on and so forth. So the whole point of this, whether it's making a lot of sense to start off with, is that carbon accounting is an iterative process, and the availability of data is what allows us to have a much more accurate carbon account. And an accurate carbon account can be used to make data-driven decisions. So what would it look like if we had, really good data for an event, rather than just saying, we know that $10,000 was spent on food and beverage, the types of food sourced, the quality of ingredients procured, the origin of the food, the number of nights stayed. All of these kind of show where we would want to be pulling smaller data points from. But this is when I would say, if you're wanting to do a carbon account, it's important to be working with someone with expert knowledge here, because the quality of data is always a big question. And this decision as to when potentially we can use this data source or whether we can't, whether we should be using, spend-based emission factors is something that always needs to be taken into account. And, we've kind of spent a lot of this first part of this webinar today just talking about, carbon accounting. But it is, this is the start, this data collection, the calculation, and the results, this from here to the left. There's a lot involved before we can then unlock so many aspects of sustainability, whether it's our target setting, our reduction initiatives, supply chain engagement, regulatory investment requirements, sustainable branding. It's all, we need to kind of set the foundation well so that we can make good decisions and so that we can represent the analysis really strongly. One thing I'll say before we kind of move on to touching on carbon offsetting quickly is that don't be afraid or scared off by not having the perfect data set to begin with, because it all comes back to being transparent with how you do your analysis. Like we've seen big companies get it so wrong on their first one or two attempts, but then they're aware of it, they're improving it. And a lot of these companies as well, like we do the carbon accounting, Zipco, the payments company, they don't really have many levers to reduce their carbon emissions. You know, they're a professional services company. So where they really put their focus and effort is around this continuous improvement piece. How are we getting better data? So we know exactly where our emissions are coming from? Because as technology advances, this is when you're going to have better levers to pull to reduce. But if you don't know and you just know that you spend $10,000 on venue hire, rather than knowing that the venue you're hiring from actually has green power or has a, recyclable, different recycling streams, you've got your organics, you've got your mixed recycles, so on and so forth, then you're able to make better decisions. And again, it's around improving your data systems and reducing waste possible. Just 2, 3 more, because I think it'd be remiss not to talk quickly about carbon liabilities and offsetting when we talk about carbon accounting. One of the main things we always get asked about is offsetting, carbon neutrality. Some really basic terms to understand is that one carbon offset is 1 ton of CO2e. Carbon accounting works in tons. So, what's a benchmark? I always get asked, or what's an amount to expect? It's very difficult. There's not enough publicly available data, unfortunately, at the moment. But a company of 20 employees, Sydney based, maybe 1 to 2 locations, you're probably looking at like under 400 tons for the year. And so then if you wanted to be carbon neutral, you'd have to offset 400. You'd have to purchase 400 carbon credits. Difference between projects and credits. Projects generate credits. One example project we were selling. We don't sell credits at NetNada, by the way, but we do have a number of partners. If you are interested in purchasing, we can introduce them to you, and we earn a 0% commission on all projects and purchases. So we just recommend as needed to help our customers and partners. But one of them may be a rainforest conservation project, and for every ton of carbon they either sequester or avoid in the development of their project, they can develop a carbon credit. Now, carbon credits can be purchased and traded. A lot of the time, they're actually financial instruments. There's a lot of people making a lot of money. And for that reason, the price is not always indicative of the quality. Australian carbon credits, ACCUs, are much more expensive. The labour costs here are much more expensive. Things made in Australia are more expensive. If you want to purchase overseas, they are cheaper, and it doesn't necessarily reflect poorer quality. But how do you offset? You obtain the carbon credit, you then need to retire it. You can only retire it once, and that's one offset. One thing I would mention as well is that you need to be carbon neutral for a reporting period. So if you're making a commitment to carbon neutrality, one thing to keep in mind is that you probably don't want to kind of say in 2 years' time that you're not carbon neutral anymore. You may change your mind, but you're committing to every year the calculation and offset of all of your carbon credits. And that's it today. I'd love to answer any questions we might have on events and event calculation. We'll send over these slides. But yeah, look, end of the year's coming up again. It's quieting down, across everyone. So if you do have any planning for the new year, wanting to put together, a sustainability plan or anything, please, my emails are open. we're not going to, it's not pushing in the sales perspective or anything. We just answer any questions you may have and, love to help. So we've got two in the Q&A. What are some practical ways to gather Scope 3 emission data from suppliers, especially when they are unable or unwilling to provide it? So one of our services that we offer to all of our customers is around supply chain engagement. So this is the process of engaging suppliers and requesting more granular data. So what are some of the practical ways? I would recommend that whoever yours calculating your carbon emissions for you, that you would request that they help you to gather the data from your suppliers. We are seeing from when we first did this a year ago to when I just did it with Adelaide Fringe Festival this week, the uptake is astronomically higher. And the reason it's so much higher around people willing to provide it is because I can bet the bottom dollar that you will not be the first client of theirs to request this data. They are now getting so many of these requests that it's getting to the stage where they're going, you know what? Actually, it's probably time that I do start to put together a plan or start to calculate my carbon emissions. And if it's not, if they don't say it to you, then at least you're contributing to, you're not even putting pressure on the way. It's a question of what they're doing at the moment, and we can assist you with this. But it at least opens the conversation to your suppliers to see what their progress may be. And second question, can you elaborate what it means to retire carbon credits? So, yes, so as mentioned, carbon credits can be traded and they can be traded between entities. You can purchase, you can sell them, but once they are retired and they need to be retired on a registry, they're essentially said that we are using this credit to offset a ton of carbon. Now, until it's retired, which means that it will be listed on a registry as being retired, then it is free to be traded. But once that carbon credit has been noted on the registry, whether it's the ACCU, the Clean Energy Regulator, there's a number of different processes for the different standards of carbon credits. But once it's retired, then it is effectively attached to a carbon credit within a business. So if you would retire 300 credits for your 2024 financial year if you wanted to be carbon neutral, if you had emitted 300 credits for the 2024 financial year. I hope that makes sense. How to determine which data points to include when setting emissions boundaries for an event. One thing we're putting together is like, what are the main, we're going to send out a worksheet, which is like, what are the main emissions sources, to include within your boundary for an event. To quickly, and how to determine them is what's material. How do you determine what's material? You can look it up, send me an email with your event, and I'll be able to do a desktop example. But as I would say, there's always the venue, which is going to give you the electricity, it's going to give you the food, it's going to give you the waste. Then there's the, what are the main, think about where the money flows is an easy way if you're very, very new to it. What are the big expenses? Where's the money being spent? And then the other one that's a major one is attendee travel. Now, attendee travel, quick note to make, is that is the only one that's really difficult to do post-event. So whenever we're doing an event analysis, the first thing I'm like, okay, well, what are you doing to calculate attendee travel? How do you calculate attendee travel? You need to do a survey of your attendees to determine where they came from, how they got there, and how far they traveled. Now, you can use estimates, you can use ticketing, work backwards off postcodes, but if you want to get it really accurate, you need to be asking a certain set of questions, which I can provide to you if you want to send me an email. Yeah, everything on that kind of list I sent through, which is like emission sources for events, that is pretty much the main emission sources that you would want to include in the boundary for an event. So when we send this out, you'll be able to see it and you can reply to my email. Great. Well, might just finish it there. Sure everyone's got lots on. Again, please shoot me any questions. I'm here to help. Everyone at NetNada is here to help. Thanks for taking 45 minutes out of your Wednesday to jump onto this. All right. See you guys. Thank you.